Welcome back to the Crypto Intellect, where we break down the biggest global crypto developments shaping the future of money in a simple, clear, and powerful way. Today's XRP update is one of the most intense and widely discussed stories circulating across the market, and it all connects to a headline that has grabbed attention everywhere. XRP news today. You need 4,211 XRP before July 4, final warning. While that specific number is being shared across social platforms and trader communities as a speculative claim rather than an official rule, it reflects a growing wave of urgency building around XRP and the broader regulatory and institutional shift happening right now. In today's video, we are not just talking about price talk or rumors. We are breaking down real institutional signals, regulatory changes, and blockchain infrastructure tests that are shaping how global finance may operate in the near future, and why investors are suddenly paying much closer attention to assets like XRP than ever before. The story begins with a major update from the Office of the Comptroller of the Currency, also known as the OCC, which regulates national banks in the United States. This federal agency has now confirmed something that represents a major shift in financial policy. National banks are officially allowed to custody crypto assets, meaning they can hold digital currencies on behalf of clients in a regulated environment. This is not a rumor or interpretation, but a confirmed regulatory position. On top of that, banks are also permitted to process stablecoin payments and integrate distributed ledger systems into their operational infrastructure. This matters because it moves crypto from a gray zone experimental asset into something that sits directly inside traditional banking rules. For years, institutions stayed away due to uncertainty, but this announcement removes part of that hesitation and opens the door for real integration between banks and blockchain networks. Now here is where things start to connect to the broader XRP narrative. The OCC didn't just allow custody in a general sense, it explicitly allowed banks to use blockchain systems for payments, settlement, and operational infrastructure. That means the technology behind distributed ledgers is no longer being treated as experimental. It is being treated as usable financial infrastructure. This is where networks like XRP come into the conversation. XRP was designed specifically for fast settlement and cross-border value transfer, not speculation alone. So when regulators approve the use of blockchain for payments, it indirectly strengthens the case for systems built around speed, liquidity, and institutional-grade settlement layers. Banks are not being told to invest in crypto. They are being told they can now build systems using it, and that shift changes everything about long-term adoption. Around the same time as the OCC announcement, another major development unfolded at a DTCC-linked institutional demonstration often referred to in industry discussions as a great experiment. This test involved multiple blockchain networks being evaluated for real-world financial settlement use cases. Among the networks named were Ripple, Ethereum, Stellar, and others. What makes this significant is not marketing or speculation, but the fact that these systems were tested in an institutional environment involving real financial logic such as collateral movement and settlement finality. In one of the most discussed moments from the demonstration, a bank-linked entity reportedly settled institutional collateral in seconds using a shared distributed ledger. That level of speed is dramatically different from traditional systems that can take hours or even days to finalize similar transactions. During this same period, data points from the XRP ledger gained renewed attention, including reports that around 77 million transactions were processed within a single 5-minute window under network stress conditions. Whether viewed as a peak activity event or a stress test outcome, it highlights a key argument often made by supporters of XRP. The network is designed for high-throughput settlement at scale. Institutional finance requires systems that do not slow down under pressure, and this kind of performance data is exactly what analysts watch when evaluating whether a blockchain can operate in capital markets environments. The combination of regulatory approval and technical throughput creates a narrative where infrastructure readiness starts to matter more than speculation-driven price cycles. At the same time, the ETF market has begun to evolve around XRP exposure, including leveraged products designed to track short-term price movement. One recently discussed product introduced by a financial firm allows traders to gain amplified exposure to XRP's daily price action. This is not a spot ETF in the traditional long-term investment sense, but it still represents something important: regulated financial access to XRP through traditional markets. A year ago, products like this faced heavy resistance from regulators and institutions. Today, they are being launched, traded, and monitored under standard financial rules. This reflects a broader shift in how regulators are now approaching crypto-linked financial instruments, moving from restriction toward controlled integration. Another major development reinforcing this shift is Ripple's continued expansion into traditional financial infrastructure. The company behind XRP has reportedly moved into areas that connect directly with legacy finance, including acquisitions involving brokerage and clearing-related infrastructure. In traditional markets, clearing members play a critical role in ensuring transactions are properly settled and finalized. By entering this space, Ripple is not just building blockchain technology, it is positioning itself closer to the operational backbone of financial markets. This is important because institutional adoption does not happen through technology alone. It happens through integration with existing financial systems, compliance frameworks, and settlement pipelines. Now, when we combine all of this with regulatory clarity from the OCC and experimental validation from DTCC-linked demonstrations, we begin to see a larger pattern forming. The SEC's evolving stance on crypto products, combined with OCC banking permissions, signals that the regulatory environment is no longer uniformly hostile to digital assets. Instead, it is becoming structured. That structure allows institutions to participate under defined rules, rather than avoid the space entirely. In that environment, assets like XRP are often discussed not as speculative investments alone, but as potential infrastructure components for liquidity and settlement systems that banks may rely on in the future. One of the most important real-world examples supporting this transition comes from stablecoin settlement tests involving institutional banks. In one demonstration, a euro-backed stablecoin issued by a banking entity was used to settle collateral across blockchain networks. The transaction reportedly moved across multiple distributed ledgers, including networks associated with Ripple technology. What stood out was not just the technology, but the speed of final settlement. Instead of taking a full business day with intermediaries and reconciliation layers, the transaction finalized in seconds on a shared ledger system. This represents a fundamental shift in how financial exposure can be managed between institutions in real time. To understand why this matters, you have to compare it to the traditional system. Today, institutional settlement often involves multiple intermediaries, manual reconciliation steps, and delayed finality. Every step introduces cost, time, and operational risk. The blockchain-based model removes many of these layers by using a shared ledger where both parties see the same updated state instantly. This is where distributed systems begin to outperform legacy infrastructure, not just in theory but in live institutional testing. When you apply this to global capital markets, even small efficiency gains translate into massive financial impact over time. Beyond settlement efficiency, the broader conversation is now shifting toward real-world asset tokenization. This includes assets like bonds, real estate, commodities, and other financial instruments being represented digitally on blockchain networks. If this trend continues, the underlying infrastructure must support high-speed, secure, and compliant settlement systems. This is where networks like XRP are often discussed, not as investment vehicles, but as potential settlement layers for tokenized financial ecosystems. The idea is simple. If everything becomes digital, the rails that move value must also evolve. Another lesser-known but highly discussed technical capability is offline transaction functionality demonstrated in XRP-related payment systems. In some experimental setups, transactions were signed and initiated even without active internet connectivity, using device-to-device communication methods like Bluetooth. Once connectivity was restored, the transaction was finalized on the blockchain. This type of capability matters in regions where internet access is unstable or intermittent, and it highlights how blockchain-based payment systems can extend financial access beyond traditional infrastructure limitations. While still experimental, it demonstrates flexibility that legacy systems do not typically offer. Now, when we return to the headline circulating across social platforms claiming you need 4,211 XRP before July 4, it is important to separate emotional market narratives from verified developments. There is no official regulatory requirement or confirmed financial rule behind that number. However, the reason such claims gain attention is because they ride on real developments: regulatory approval, institutional testing, ETF launches, and infrastructure demonstrations. When people see multiple signals happening at once, speculation naturally increases. But responsible analysis requires distinguishing between confirmed institutional changes and viral interpretations of those changes. What we can say clearly is that the environment around XRP is changing rapidly. Banks now have permission to engage with crypto infrastructure. Institutional tests have demonstrated real settlement use cases. Financial products tied to XRP are entering regulated markets. And blockchain networks are being evaluated alongside legacy systems in real-time financial environments. These are not isolated events. They are part of a broader transition in financial infrastructure. And that brings us to the bigger picture. Whether you are an investor, observer, or simply following the evolution of digital finance, the key question now is not whether blockchain will be used, but which networks and companies will form the backbone of that system. The developments we covered today suggest that the competition is already underway, and decisions being made in regulatory offices, banking institutions, and settlement systems today will shape how money moves for decades to come.